All right, we got the recording going now. So right now I can see what I'm looking at. So I know the screen share is going on. Okay, like usual, everybody, this is a market mastery session. Y'all know who I am, Jay, your favorite economist, investment analyst, that dude. Uh, one smooth dude on all social media platforms and all the rest of that stuff. I might put this one on YouTube, depending on how well this goes and how much information I put out and how punctual I am today. We'll be doing a Q&A session as well. If questions pop up, feel free to unmute your mics and ask the questions and do that. I'm fine if this session trails off for more Q&A than the analysis. We have until Wednesday before I plan on even getting active in these markets. The reason being, if we come in, we take a look, we have not one, not two, but three monetary policy statements this week, right? I think this is Wednesday. This one is technically still Wednesday because in Japan's like 14 hours ahead. So it's still going to be Wednesday for us, but it's going to be the 31st for them. And then the CAD. So the CAD's going to lead it this week. If we come over here to Forex Factory, we can see all of these things. And I'll go ahead and filter this because there's only a few things that we really need. This. I was wondering why I wasn't already filtered. So again, Forex Factory has this filtering option over here. And now I've only got the high impact news filtered. We're still looking at growth. We're still looking at inflation, growth being productivity. So this would be the GDP statements and things like that. Inflation would be the CPI statements, employment, unemployment, of course, the central bank statements that we're talking about, monetary policy statement, bond yields, housing, consumer service, all the rest of those things. But and then all the currencies as well. So that filter's already applied, and this is what we get, right? So my eyes immediately jump straight over to these monetary policy statements. I'll allow all of this to kind of set up the week, right? This Aussie CPI, depending on how these numbers show up. If we want to stay out of the volatility coming from the CAD statement, the dollar FOMC statement, and then the Japanese yen's tentative. Because when the Japanese yen does their monetary policy statements, they're never um, dead set on a time. It's usually some random time at night in between like 7 o'clock Pacific Standard Time. And if sometimes they do it at 5, you never know, right? Sometimes they wait till 11 o'clock at night right before they turn over. You never really know with the Bank of Japan. So you kind of have to, if you're gonna try to trade the yen monetary policy statement, for time purposes, like me, like I'm in the West Coast, so sometime I can hawk the charts from 7 to 11. That's fine. I'm awake at that point. But waking up at 5:30, 6:45 to trade the CAD monetary policy statement may not be what I want to do. So what I'm telling you guys that for is to let you guys know there's at least three types of ways to trade these monetary policy statements. You can trade on the time of the statement. You can trade before the statement, of course, right? Or you can trade after the statement. Each poses its own risks. If you trade before, you risk showing your positions and being stopped out before the move actually takes off. If you trade on the time, then you risk the volatility and the slippage that comes with trading in that most volatile time. And if you trade after, you could potentially miss an entry that you wouldn't be able to get into, and the market may be moving very quickly away from an area that you intended on um, operating the market from. So you could feel if you're a trader that has problems with FOMO, then trading after may not be something that you want to do because it may make you anxious and put you in a worse position. All of those things need to be factored into your trading plan before you trade on Wednesday, which is why I'm doing this early enough so that you can get your mind right. So you can go in, get some back testing done, look at these different charts, either futures markets, forex markets, or complementary markets, or markets that are not complements or substitute markets for Canadian dollar, Canadian goods, or the US dollar, US goods, or Japanese goods in the Japanese markets. So you guys can find ways to hedge, find ways to do things, or you could just trade bilaterally and set up buy stops and sell stops, which is something that I'll probably end up doing. But we'll talk about that a little later. But I just wanted you guys to be very aware of the times and of the statements that were happening on Wednesday, right? This Thursday also, right? If you're trading after, we also have a good setup here where we have the Canadian gross domestic product, which again is growth. If the economy is not growing in relation to inflation and in relation to their interest rates, that says something that causes either appreciation or depreciation in their currency. And, that's a good focal point here, which uh, you know, deems it a red folder category, which maybe if you want to stay out of the mix, um, then getting back in on Thursday for the Canadian dollar or that New York session, and you can get a good price move or a continuation move based on the core PC price index, which is a consumption expenditures, personal consumption expenditures. This lets the Bureau of Economic Analysis know where and how much people are consuming and the change in prices in relation to how much people are consuming, right? So if that core PCE price index increases, that means inflation is going up, or people are consuming more in relation to inflation, things like that. Employment costs and also unemployment claims, that goes into kind of the contrary to how much people are spending, because you can only spend what you've earned, which is extra, right? And what you don't spend is what you save. And you can't earn or save or spend if you don't have a job. So unemployment claims are something that lets the economy know. It's a good barometer of, economic prosperity, how well we're doing recessionary activity. If we're in a recession, then our unemployment rates will go up. And those are two um, complementary signals there. So if unemployment is low, then that means our economy is functioning well. So a good unemployment rate is around 4%, right? It's common. There's something called frictional unemployment, and then there's something called structural unemployment. But frictional unemployment always exists. There will always be somebody looking for a job while the job is looking for that person. In this day and age, we have things like LinkedIn, we have things like Glassdoor, we have things like Indeed that help lower that friction and allow people to find jobs quicker. But say the nat the national rate of unemployment is commonly at around 4%. So if it goes up to around 4.2, that's not crazy. These numbers do increase, like I always talk about, these numbers do increase by demographic and by age group. So I believe Asians are about 3%. Um, Caucasians are around 4%, around the national average. African Americans are around 6%, and teenagers are around 8 to 10% rate of unemployment. The teenagers are higher because of structural unemployment, because they'll be looking for jobs more, but as the minimum wage increases, they have to be more skilled, and they're teenagers, so they don't have tangible skills yet, which is why unemployment rate goes up higher. And we understand why African American unemployment rate is higher than uh, the other nationalities because of everything that African Americans have to deal with in the United States since the beginning of the United States. I'm not going to go too deep into that this time, but that's why I do what I do. It's for economic empowerment. So I want to teach you guys economics while I do this, but you guys know the history of the place that you live in. So I'll leave that there as we keep on continuing on what we got going on. So that's what's happening there. So let's go take a look as I move through on a separate screen. I have my, maybe I could share this with you guys. I've got my, which I'm also, yeah, my currency board that I'm also, where is it? Boom, boom, boom. There. You guys can see that, hopefully. I got my currency board, which I'm also updating. I got some notes that I've seen from my overall economic analysis for this week, looking at commodities, bonds, and stocks, just how they're moving and what's going on there. But I've got this Excel spreadsheet that automatically tallies up and scores each of the currencies, each of the fundamentals that we'll be looking at. But right now, we'll be looking at the equity markets. So when we talk about investing and investing as an economist, I mean putting money into something for a gain at a later date, right? So expecting to buy something in exchange for more profit at a later time. That could be capital, that could be storage equipment, that could be like really anything that if you buy it for the purpose of capital gain, that is an investment. But what we talk about here as far as trading and investing, there are two types of those, right? So there's debt finance, right? And equity finance as far as those two go. So debt finance is bonds, right? So bonds are basically IOUs from either the government or a corporation, right? The corporation bonds are called junk bonds because there's so much more risk to holding up an IOU for a corporation that's doing a startup, right? Out of their garage, basically saying, hey, if you give me X amount of dollars, I'll give you this amount of money back after this maturation date, this amount of time. I'll give you back so and so percent, 5%, 2%, 10%. For a junk bond or a corporate bond, the the yield to be a lot higher because there's more risk. For bonds, like government bonds, like treasury bonds, the risk is higher the longer the period of time. So as you guys can see here, if you see the 30-year treasury bonds are at 4.9%, while the 10-year treasury bonds yield 4.386. The reason being is it's riskier over a 30-year span to hold your money. A lot of things can happen in 30 years to where you may need that money back. So they have to make it worth your while, right? So as we look back, right, we see that, equity markets and bond markets and commodity markets have this correlation, counter correlation in between each other. Commodities, bonds, and stocks, and crypto is kind of nestling its way in there, as they call crypto now digital gold. And Bitcoin is a digital version of gold, which is a commodity, right? A hard commodity. So yeah, that those are the things that I look at and how the world views all three of those asset classes, including crypto, equities, bonds, stocks. Well, equities are stocks, commodities, bonds, and stocks. CBS is what I call it. And yeah, so we look at that. We look at the interest rate outlook, whether they're bullish or bearish, whether they're expecting to hold rates steady, whether they're at target the 2%, inflation target, whether they're, whether they do have a sustainable economy with minimum unemployment and maximum job availability and things like that. So we'll look at that and we'll see whose fundamentals match their technicals, and that's what I'm going to be doing today. Like before we jump into saying any chart looks good, let's just go make sure. So whew, without further ado, I'll be doing all of that in the background because I want to make this go as quickly as possible. Like I said, I want to be punctual with this. This usually takes me a couple hours. But questions may arise. I'm not going to take 2 hours to do this. I'm already over halfway done with it. Um, so I've done majority of the commodity bonds and stocks analysis, which is inside of this weekly note area here. But right now I'm looking at the equity market picture. And I'll bring you back over to the Wall Street Journal. Okay, so we're back here at the Wall Street Journal. At least we should be. And I was just looking at whose equity markets are the strongest. So in hindsight, last week we had a euro monetary policy statement. So the ECB, the European Central Bank, released that they are going to hold their rates at 2%, which is the target rate for every central bank. It's a 2% inflation target, 2% interest rate. It's like this sweet spot. And it's where everybody's, at least single mandate is for price stability, and stable prices are naturally around that 2% interest level. Okay. So with that being said, they have a very stable economy. With a very stable economy leads to more influx of imports and exports, right? So you can export more when you have a more stable economy with low interest rates and low prices and good value products. So other countries will want to buy your products, which then will increase your exports, which increases your gross domestic product and helps your economy flourish and your businesses flourish. As we can see, the Euro Dow, right, which is like the Euro Dow Jones, the Euro basket of the top companies in Europe is up 21.47%. Okay. So to make this make sense, their bank says if you take your money and put it in the bank, we'll give you 2% interest on your money. But if you put it in the stock market, you'll make year to date right now is 21.47%. What do you think everybody's putting their money in Europe? If you're smart, you'll put it into the stock market in your favorite European stock. Because in January, you're at zero, but by July, you're up 21.47%. In January, you're up zero. By July, you're up 2%. Okay? You see how the bank rate influences people's spending habits. They understand that. Okay. And now, if it isn't in equities, where else would they go? They would go to bonds. If the equity market is low, then they do what's called open market operations and they buy and sell bonds to increase the money supply within that country. You increase the money supply, you change the real wealth inside of that economy. Your real wealth changes, people either buy more or less of things, and that either stimulates or compresses the economy. Deflates, right? So looking at the Swiss market's at a 3, and looking at the UK markets, the Great British Pound, and them, they're at, if you add these two together and divide by 2, it's like 9.4%. So close. So whenever I see these things, if you're at 0% to 4% on my currency board, I give that a 3. If you're -1 to -9%, I give that a 2. If you're less than or equal to -10%, I give that a 1. And then 5% to 9%, I give that a 4. And anything greater than 10%, I give that a 5. Okay, so that's just how I measure the relative strength of things like that. So that's what I'm doing on the Excel spreadsheet. Everything else is similar to that. It's a similar scale. And we're looking at everything like that. So simple as that. So that's what I'm doing on the opposite screen. Pound still a 4, everything's still a 4, Swiss is still a 3. And yeah, so nothing's really changed since the last time. So I did another currency board on the 8th of July, but things have changed. Things have definitely changed a lot since then. So here, let's come take a look at some of these other sides. We're in Asia now. We're looking at how everybody in Asia is responding to their bank rates and everything else. So the total world stock index is what I was looking at. So the assumption is that everybody is risk on at this point in time. Everybody is putting money into their equity markets except for the Kiwi. So the Kiwi is still at a 2. Yep. And the K is no longer at a 2. Their equity markets are doing better. And Australian All Ordinaries is at a 4. Okay. Coming and taking a look at the US equity markets. Now the US, we could go take a look at that. If you guys are stock traders or if you're trading NAS or anything else like that, this is what you're looking at for the year to date. And if you looked at the chart at the beginning of the year, we were in that distribution that we called. Prices broke down, and then we came back up into the range. Come June, we were at 0%, right? And now this is where we are, up 8%. This is exactly what the chart looks like. So the strength, if you didn't catch it here, it's here, right? Is where you should have noted. Because it's like I was just watching Clarissa Shields and the rest of the boxing matches, right? And the dude before that, he got knocked down on the 9th round, right before the bell, right? So assuming he got knocked all the way out the ring, right? He gets knocked out. Everybody, all the announcers are like, "Oh, he's gonna have a hard time in this 10th round. He better." But he immediately started fighting back, like fighting back in a way that was just like, "Wait a minute, right?" You couldn't even tell he got knocked down in the 9th round. Like he hit the dude with so many uppercuts, I lost count, and that's all I just count stuff, right? So like that's the same sentiment and feeling you should have when you see price distribute, exit this range, and end up back in the range. That's as if a boxer got knocked all the way out of the ring and then got back in the ring and started fighting even harder than he did when he got knocked out. That is a sign of strength. So as we continue to push up through the seasonal trend, I do expect some of this to lose some of these gains come August because that's just the um, seasonal norm around August. And then prices should kick back up November, December, and that's why we do the wealth management retreat in December as well, because we could catch this movement back up as they produce the next range to start the next year, maybe get ahead of some other things and really see where prices are going. So there's a method to the madness, is all I'm saying. And looking at the US dollar, it's back up to a 4, which is good for me. And we're going to come look at the CAD, which should be at a 10. Yep, it's at 11.19. You guys want to come look right here. That's where I'm looking for the Canada S&P TSX composite. It's 11.9, so that's a 5 in my book. So all of those things still remain the same. I'm not sure if much has changed. These haven't gotten any worse as of last. Oh, we're not there yet. These haven't gotten any worse as of the 8th. So the 8th was the last time I was actively looking at everything. So let's take a look. Pound GDP came down. Pound GDP is negative now. So I need to change the GDP for the pound to a 2. Economic activity for the pound is a 2. Uh, got the RB&Z statement, 325, they held rates. It's fine. Unemployment rate for the dollar came down some, which is good for their uh, Aussie rate. They increased. Oh no, they stayed. Aussie stayed where they're at 385. Okay, and that is July 6th through 12th. Next, dollar CPI stayed the same year over year, increased just a little bit, not too much, not anything crazy. Um, Here, the CAD month over month came down a lot. So inflation may have come down a little bit there for the CAD. It's not quite showing up here, but yeah, inflation, it did show up here for the year over year change. So inflation's coming down a little bit for the CAD, which is good. That's a good sign. Um, it's a good sign for the CAD. It should be strength for the economy. Pound CPI increased to 3.6. Heavy inflation out there.
Jay,
Uh,
you
what's up? Oh, we can you see it?
uh-uh. You still on the currency board.
Oh, okay. Let me get you back over here. Well, I technically gotta change the currency book. Nothing's really changed yet. So I'm on it, but I'm not on it. I'm just looking at Forex Factory real quick, and I'm not really like
Okay.
changing too much. But the I'm looking at these, and if they have changed, then I will change those blocks on the currency board for inflation. Remember, inflation
Yeah, yeah.
is measured by the CPI. The economic activity is the GDP. Interest rates are the bank interest rates, and the stability is based on that. And then the equity market. So I'm just
Okay.
jumping back. Last one I did was on the 8th, so I gotta hop back a couple weeks just to make sure I'm not missing anything.
Okay.
So core CPI change. So the core CPI is this core PPI. Never mind. That's not the CPI. Producer price index. That's how much producers pay for everything except food and energy, because food prices change, energy prices change, and in a month they change so much that they can't really. Those are the only two things that are so volatile that you just want to, for ease of math, you just keep those things out. Everything else remains the same. Okay, nothing really changed there, and now we're pushing up into last week. Remember last week he had that ECB press conference that we talked about in that monetary policy statement. They stayed at 2.15%. So like we talked about, that 2% target is where they are, and they're hovering there. They don't gotta do much, which is why they're already at target. They've got a good economy, one of the largest, actually the futures markets are, with at least the dollar basket, that DXY that everybody looks at is heavily comprised of the euro US dollar pairing, because there's so many euro contracts, euro USD contracts that open and close in a certain amount of time. So Tokyo core CPI, so inflation's going down in Japan, so that's not bad. Nothing really crazy. Unemployment claims still coming down for the dollar. Durable goods. Trump spoke. A bunch of people spoke, so we should be seeing all of this show up on the charts right now. CPI is coming down. Inflation's coming down for Kiwi. So good. Nothing too crazy. Nothing's really jumping out that's like that should have changed much. Um, so yeah, I think everything else really relies on the chart. So enough of the fundamentals. Let's get to the meat and potatoes, my favorite part, the technical analysis. So next, I've got another chart down there. We've already looked at what is going on as far as the fundamentals, what times we're going to be looking to be in the market, um, what news events could trigger more volatile price reactions, and we're going to hover around those times this week. I know a lot of traders like to trade certain sessions and the rest of those things, but I think without knowing what's going on in the market at what times, you really don't know when to be in the New York session or when to be in the London session or when to be in the Asia session. So we know now New York session is going to have volatility on Wednesday. Asia session is going to have volatility to either open or close it out. And then, yeah, going into Thursday and Friday, it's leaning more towards the New York session. But if you want to stay out of that, mass amount of volatility. You can play the euro, you can play the Swiss, you can play, I mean, not the euro. Yeah, you can play the euro, you can play the Swiss, you can play the Aussie, you can play the Kiwi. I do plan on trading whatever's weak against whatever's the strongest. So I want all the smoke this week. Here, if you guys are familiar with speed lines, we got some speed lines drawn up here on this chart, which I have is a relation between the S&P 500 and the 10-year bonds. Remember, equity finance versus debt finance. How do the larger operators, uh, how do they weigh their opinions, their sentiment? Are they leaning more towards safety? Are they leaning more towards risk? In this category, we can see that they're in an upward speed line. They've contacted the second speed line and have increased their velocity since they've done that to the upside. The downside momentum has decreased, and yeah, it looks like we're more of a risk on market than not. Now, when we take equities and we put those up against commodities, we got the US 30 against gold. And here we can see that equities are pushing up against gold. However, we are pulling up into this resistance at the same time. However, we are well above 50% of this downward sloping trend channel. So if we do like a 50% mark here, we'd be well over 50% of that. And then we've got this mini channel here that's already broken out above all of that and starting to make its way out, which will be phase D and phase E of a Wyckoff accumulation on that. So we got a smaller, more fractal version of a downward trend channel breakout that could propagate into a much larger version of the same trend. So just keep those things in mind when we talk about where we want to look. Do we want to buy gold? Do we want to buy uh, equities? Or do we want to buy crypto over gold and equities? Because again, we have crypto making the same sort of movements, but here on the weekly, we can tell we've come in contact with this lower support and we're pushing up into the 50% here. And it looks like we're diminishing in supply. Supply seems to be drying up a little bit. So Bitcoin does look a little bit better than gold. Remember, they're calling Bitcoin digital gold. So don't lose sight of what is kind of going on at the moment with Bitcoin. Bitcoin's doing well. It hasn't really shown any reason not to believe in it at this point. As we move up into this, we know we contacted this resistance. We're still above the 50. We can still make a way up into these highs for Bitcoin versus gold. But these are just things I want to correlate these things for you guys to see how things are moving in relation to everything else. Here we talked about equity markets, and remember the Clarissa Shields analogy, how we had, and it's kind of like all chopped up right now. How we had the distribution, we had the change of character, it broke us down, but then we ended up back into the same range where the character was once bearish. Now it's extremely bullish, and prices are continuing to make their way up. So I just want you guys to see that. Same thing with the same exact pattern and everything else here. The resistance that has been broken, retested as support and continuation. And this is on the total world stock index. And these two charts are the exact same picture that we saw on the Wall Street Journal, where we have almost everything except for the Kiwi equity markets are bullish, at least 10% bullish. And everything here is also very bullish in relation. And the VIX will be the opposing force to that. This is the fear index. We expect fear to be down when risk is up. And then gold, like we talked about, gold looks like it's in. As we were looking at this, we've got our 5-wave Elliott wave with the extension on the first wave, wave 2, wave 3 to 4. We see an increase in that supply. Wave 5 to 6, we see another increase in supply, which sent price sideways and creates phase A of our stop the trend action. And then we've got phase B where we contacted the maximums and minimums. Now we're just waiting to see which side really gives way, right? If we are in a reaccumulation and gold finds strength, then we will want to see a diminished supply as we come down here. But if we see an increase in supply, where we would end up creating a major sign of weakness here, where prices would break down below here, create an ice line that would be somewhere similar to where we have this here. That's where we would look at to short this market, and it would give us that same classic distribution pattern, the mushrooming over effect, and we would see that, and we'd have to see another change of character where prices are no longer kind of allowing themselves to come up through this this consolidation like this. We would want to see this streak through the entire consolidation bearish without really stopping to find any bullish support. And that would be the change of character that we would see and would want to see to let us know that this market is actually distributing and not in a reaccumulation. Now, the reaccumulation would be nearly the exact opposite, where we find strength with diminished supply. Prices then would break out of these highs and continue with the upward trend trajectory. So these things, while we're looking at this, this is gold in relation to the U.S. dollar. U.S. dollar has a monetary policy statement. This could be something that we look at to trade against, right? Same thing here. NAS is going to move similarly as the rest of the equity markets, right? We had our distribution, the boxer hopping back into the ring, and then prices continuing to go up. So little things like that. And remember, we talked about equities. I wanted you guys to see what I was talking about. So equities, I mean, and bonds. Bonds aren't really the hot ticket right now because we're risk on. So you see the 2-year bond is sideways. The 10-year bond I would consider as sideways within this area, and then the same thing with the 30-year bond, really trending in between those EMA, not really doing much. Crypto, you see XRP and the rest of these trending after contacting the highs. We were talking about XRP not too long ago. Doug trapping myself out here in San Francisco. We went and saw a trap. He pulled up on us, and we did an analysis. Analysis came out spot on. We can see that supply did introduce itself up here at these highs. We see the ultra high volume spike coming in there, and then as well as down here on the bottom. So they're both buyers and sellers alleviating their positions. Volume has dried up a whole lot. We're really just in limbo right now with crypto. It did make a good move up. Hopefully you guys got the ability to take some profits or hedge your positions or do whatever you need to do at these highs. We did see supply come in, so that is a exit for me in a way. However, we are in positions a whole lot lower. in here. So taking some profits is definitely necessary. It's a take profit or don't gain. So that's why we do what we do. So as you see the supply introduce itself, you definitely want to use that as an exit criteria because I do. ETH, Bitcoin, the rest of those ones, the Shibs, the Cardanos, the Dodgers, they all look the same. So coming over here, let's go take a look at the relative strength outlook so we can get done with the currency board. So here we've got the dollar on the 4 hour. I'm gonna hop back into the triple screen so I can do a top-down analysis all at one time. So we got the 4 hour, the daily, and then the weekly all here, all at the same time. So I don't have to go back and forth and try to figure out which one looked more bullish or more bearish or what was giving me a false signal. I could see it all at one point. So here we've got this proprietary basket set up of the dollar equally weighted against every currency. Because remember, like I said, the euro dollar currency pairing is, I mean, the DXY is heavily weighted on the euro dollar currency pairing, and it doesn't give you a very accurate measure of the rest of the currency pairs against the dollar. So here we got the dollar as the dominant pair against everything, and you'll see that same thing against every other currency pair. We'll have the yen, we'll have the Swiss as the dominant, we'll have the euro as the dominant against everything. We'll have the, you know, so that's how I do this. This is how we do this at Maverick. So I'm marrying the two procedures and processes of volume spread analysis, the Wyckoff methodology, with proprietary trading tool that we use at the firm. So sit back and enjoy the show. So right now we can see that the dollar is trending pretty much sideways, but with a downward trajectory. I think I already did run through everything I looked at except for the COT for this one. So I've got this one marked up as the looking at the trend score. We'll look at the trend as the daily chart. The daily trend is pretty much sideways. So I gave that a Mm, I gave that a, I gave it a two. But it's a two because it's below the red line is the 55, the green is the 21, and the blue is the 13. They're Fibonacci EMAs. So if you're below, if it's red, green, blue, then that's bearish. If it's blue, green, red, um, or red, or yeah, blue, green, red, then it's bullish. But red on top, that's bearish. Red on bottom, that's a sign that's bullish. And that's the 50, right? That's a lot of traders use the 50. Um, so yeah, that's what I do as well. So if it's below that, then it's a two. If it's breaking down below that and structure, then it's a one. If it's wrapped up in the EMAs, then that's a three. If it's above the EMAs, that's a four. If it's breaking out above the EMAs, that's a five. Okay, so right now we've got a two and a three. So that's what we got. That's how I measure that. Next, we've got the Japanese yen. It should be, that's the way I've got it written up on mine. Yeah. So here the yen is a two. Mm, I would consider that it's like two twos across the board for the yen, which is actually stronger than it was last time. Next, we've got the euro. Now, the euro, like we talked about, the currency should be strong. The equity markets should be strong. It should be very, very strong. And that is what it is. In the face of the fundamentals and in the face of technical analysis, this thing is doing absolutely great, right? And from an economic standpoint, to it's right here in everybody's face. I think this is the outlier for all economies this year. He should be looking at the euro. He should be buying euro stocks. He should be doing everything euro related right now. I really do like the way the euro looks. I like it here on the because you can see the the big engulfing bar, the slight pullback. Yes, we do see that the bearish momentum is increasing, but the bullish velocity is increasing more. And here we can see the momentum is decreasing here for the bearish move, and we have a nice move to the upside here on the weekly as we're going up through this resistance level. So I think the euro may still have a little bit of oomph left in it, and it looks like it's definitely the strongest. It's up above the EMAs on every um, time frame, and it's breaking above the highs as well. So here's a 5 as we would consider, because I'm saying the highs not so much as the wicks on the top. I'm talking about the closing prices. So closing prices, the highest closing prices that I'm looking at are here. We're breaking out above these highest closing prices, and that's where we are right now, above those highest closes. So yeah, and it's even here on the weekly. So the weekly looks like a 5, a 4, and oh, it's tough, but I'll give that a 4 as well. So 5, 4, 5, 4, 4. The euro has actually gained strength since last week. Next is the Great British Pound, which I think I passed. I passed it. No. Here we go. Now the pound is losing some strength. We talked about why this might be. We could see that the pound had a 3.6% on their CPI. So that shows that its inflation is really running rampant in the UK. So when your goods are inflated, people buy less of them, which then depreciates your currency. Right? So your net exports goes down. You have to import more, lowers your GDP, lowers your productivity, depresses the value of your currency. Okay. So that's something there. Pound's losing a lot of strength. I got it as a 3 and and 2s everywhere else. So I'd say the trend score is a 3, velocity score is a 2. And also on the 4 hour, it's a 2. Next is the Swiss franc. And Swiss is holding up well. I would give this a 4, and a 3. Not bad. Swiss 444, and then a 3. Canadian dollar. We have the Canadian dollar coming up this week, so pay particular attention to this. And it looks like 2, 3, 2, 3, 2, 2, 3, 2, 3, and then I'd say we got a 2 on the 4 hour. Now we need the Aussie. Australian dollar, 3, 3, threes across the board for the Aussie still. But the fact that the Aussie hasn't gone up or down is a sign of strength, especially in relation to the Kiwi. These two economies are very similar. With both small islands. Tourism is like one of the main things, but they also trade precious metals, and they've got different types of cattle and things like that that they utilize. And they also do a lot of sort of digital equity sort of things like property rights and things like that. So here we got a 3 on the velocity score, 2 on the trend score, and it looks to be almost a 3 on the 4 hour. So now that all of that is done, we've got a currency board that looks like this. Now, the next thing is this commitment of traders data that we got to come look at. Everything's almost done, but just looking at the way things are right now, the green are the pairs that have the most strength. So in the midst of the US dollar, the yen, and the CAD, if those go down, I would expect them to go down against the euro and against the Swiss. So if we're going to trade dollar short, I would trade dollar Swiss short. I would trade euro dollar long, right? I would trade um, Swiss yen long. I would trade euro yen long. I would trade CAD yen, euro CAD long or CAD Swiss short for these monetary policy statements, and it's pretty apparent there. Now, we also have to have contingent positions. Now, if prices don't, we have to have a bullish narrative. So if the CAD is just weak enough to where its weakness capitulates sellers and entices buyers and then causes things to swing, I would then say I would buy a CAD I would short a Kiwi CAD position, or I would go short a pound CAD position, based on how the markets are starting to trail in opposing directions. So that's something to be aware of. But as we go back through and look at the COT, we'll see we'll have one more added um, sentiment that we can look forward to. So I'll show you this tool that I use. So there's two ways you can look at the COT, and I'll show you. There's a super duper technical way, which a lot of people don't like. And then, so we can come look over here at the COT. This is the Commodity and Futures Trading Commission. This is the data that I just posted in the Pips and Pancakes group and all over the internet too. That the Commodity and Futures Trading Commission publishes every Friday at 3:30, but they get the information to themselves on Tuesday, but they publish it on Friday and give it to the public. And it says the amount of positions that are being held long, held short, by people with positions large enough to have to report them, as well as non-commercial entities and retail traders and speculators and things like that. So it just lets you know if people are interested in a commodity, or if they're losing interest in that same commodity. So we'll look at something like the the pound, right? No, a Great British pound, not pounds of butter, but that this just lets you know that they're looking at everything, right? Pounds of butter, pounds of milk, pounds of live cattle, pounds of cheese. But I'm looking for the Great British pound. So there's a way that you can look at it here. You can look at the changes in the number of contracts, right? The total number of changes, total longs, total shorts, the change in open interest. Um, you can look at it this way, or you can come over and look at it like this, right? You see, plus 8192. This is trading stir. So I'll go ahead and put this in the chat. This is a better way to look up COT. It's in the chat right now. If you need that. I like this one a lot. It just makes it a real quick and easy way to come look at this COT without having to do all the rest of that. Like they come through, they do it for you, put it in a nice visual. Okay, so the pound is up 8,000. And I do this the same way. The way I mark this one up is if it's greater than 10,000, then that's a five. In the same way, instead of just 1 through 5, if it's 9K, if it's 9K to 5K, that's a four. It's 4K to zero, it's a three. If it's less than, zero, then it's two. If it's greater than negative 10,000, then or if it's less than negative 10,000, then it's a one. That's just how I do those. So
Quick question, quick question.
What's up?
What's your thoughts on the discrepancy between non-commercial and commercial positions? See how the non-commercial had they taking out shorts, and the commercial side they going heavy into the longs.
Hmm. So the commercials are the one with more of it. So when we think about open interest, we think about contracts. And each one of those negative and positive 17,996 and negative 13,746, those are contracts. And a contract is it's an agreement between a buyer and a seller, right? That's all. You need one buyer and one seller to make a contract. These contracts do not go up unless you have a brand new buyer and a brand new seller. They don't go down unless you lose an old buyer and lose an old seller. A new buyer and an old seller, they can make one contract, but whenever they close it, the old guy is giving the new guy his position, so it doesn't move. So, in order for these things to happen in a contractual way that then shows up as a price chart movement and some disparity that has to be there in between the two because there's some equilibrium and some balance that we're looking at. That change is shown up here as this one position here. This is the change in overall open interest. So regardless of who's buying and who's selling, this won't go up unless both parties are buying at the same time. New buyers and new sellers are showing up. So, and in order to be like, so we take this positive 8,192 and we look at that up against the direction that the chart is going. Because if it's positive, then they believe that the direction the market is going right now is correct. Now, if the market's going up and open interest is going down, then that means people are losing interest at this level. And it's probably more likely than not the commercials that are losing interest because they have more to sell than non-commercials have to buy. And if they sell more, then those prices are more likely than not going to continue going up.
Gotcha.
So so we look at it in it's like a counterintuitive way, but at the same time, it's like I look at it as like as a disgust indicator. Are they interested or are they not interested? Do they like to eat their vegetables or don't they? I literally think about this as like you handing a child a plate full of peas. Either they like it or they don't, and you'll know by how much they eat of it. So that's what this really shows. And not to get too wrapped up in the who's or the what's, this is the number that I'm paying the closest amount of attention to because it won't move unless those contracts are being added or being subtracted in bulk. Oh, that makes sense. And I could send you a
That's
PDF
right.
as well. I think I might have that already in the. It might be in there. I might not have sent it to the Pips and Pancakes group, but will that I for sure put that in there. It's a
Okay.
volume and open interest and how to relate those two um, in a quick little nice little chart
Cool.
to show you. That's gonna show up in the in the transcription. Jay to give the chart reading, but it's all good though. I got it. Um, so for sure. Good question. Really good question. So we positive 8,192 there. And that's a really tough concept to get to, by the way. It's a really tough concept, but it's one that I know that there are successful traders that only use commitment of traders data as their signal. Like Larry Williams used the same commitment of traders data in the World Cup trading championship and grossed 11,000% in a year. So he took a $10,000 futures account to $500,000 plus. And he said he had it up over 1 million, but he lost 500,000 and being aggressive. So, and he's got the highest grossing win percentage in a competition that's been documented like since yeah, I think it was in like 1986. So I'm like, and he used COT and soybeans because soybeans are harvested at a certain time of the year, which means they're sold in bulk at a certain time of the year. And remember what we're talking about, regardless if it's buyers or sellers, whenever they're selling, you'll see it here. There'll be a big amount leaving. And you can time that with the seasons, or you can time that with a climatological change like El Nino or La Nina or um, a hurricane or anything. If you know the uh, the commodity that's affected by that, you can definitely get ahead of that because you know they're going to harvest it up. They need to because they never know when they're going to have to when they're going to be able to plant it again. So they see those storms coming and they get to moving. Pound gets a 4. And we're gonna start back at the top of the list. Dollar only plus 548. Not a lot, not a little, enough to hold. Everybody looks like they're just waiting, right? That's what I get off of that. But they feel like they're in a position to where they can be where they are. So that's a 3. And then we got the yen. Look at the yen. Yen's minus 8,310. A lot of money flowing out of the yen. So yen's going down, money's flowing out. Now, selling in a downtrend is that's that's harmony. So that may be a continuation there for the yen. So the yen's at a 2. We look for harmony, we look for disharmony. If those don't match, then we gotta change how we're playing. Now the euro plus 23,000. That's a 5 for the euro. And this shows up on 722. Okay. This is as of 722. This last week Friday, which is after their monetary policy statement as well. So it just shows the truth in the fact that we saw that their economy got stronger after they decided to hold their rates steady. Shows they're not in any hurry or any rush. Their economy is doing just fine. Next is the Swiss plus 1,426, what gives me a warm fuzzy to say, hey, if the Swiss, they're holding things pretty steady too. They're not in a bad way. The little thing notes about Switzerland, their bank is said to be on top of a gold mine. So when you see gold go up, you see Swiss go up to match that. And then also they're really neutral in times of war. They don't take any sides. They're like main thing is the neutrality, which is why their their flag is like the cross, like the medical looking cross, the white medical looking cross. That's their like claim to fame. They're not on anybody's side. So put your money in their bank. Um, that's how they roll. So it's usually a strong economy regardless of what's going on in the world. CAD negative 1,825. So that gives the CAD a 2. Remember, we saw the CAD trending downward. That makes sense. This is as of last week. People were saying, maybe it is time to sell those positions. Not all of them, just some of them. Now, remember, the syndicated operators, they'll sell into their buys and buy into their sells. They have people that want to sell and need to sell to make a profit, and they got people that want to buy at um, at lower than the fair value or at wholesale value. They want to buy at those levels, so they'll coordinate those movements so that they can all win at the expense of everyone else. So, aware. Plus 10,000 over here for the Aussie, which is a good sign for the Aussie. Remember, it was holding sideways for a while. So now if we'll risk on, this is a risk on pair. Those risk on movements up against the yen. This may be a good Aussie yen. That's one of my favorite pairs to trade. Aussie yen does get a good look summertime, especially whenever you got a nice risk on sentiment. And depending, sometimes the markets can be risk on and then other things happen. So just be aware. I went back to the yen. I didn't need to go back to that. The Kiwi. Kiwi's up 2,000. That's a three for the Kiwi. And now this concludes the currency board. And now we have some more realistic realistic numbers. Okay, so here, as we look at this, we got the euro, which is the strongest currency. It may be a little bit overextended, but it's definitely strong. We've got the Swiss franc, which is strong. I like the Aussie being like the dark horse. It's just hanging out. It's neutral. It's not strong. It's not weak. It's just hanging out, ready to break out in either direction. And we have three things that may give us that directionality, that linear movement based on their monetary policy statements. Now we do expect the dollar to hold rates, which then maintains its strength. 4.5% yield is better than some countries are doing in their equity markets. We're doing that in our bank, which then tells the Kiwi market, yeah, let's just go buy US bonds. They're at 4.9%. Let's play it safe. Let's just go do that, right? For everybody that's not doing great. For everybody that has some money to spend and wants to go play, they'll go play in European equities. They'll go play in the equity markets in general, right? The dollar and the U.S. equity markets and all the rest of the global equity markets anywhere, but in their own countries, slow moving, slow percentage gaining economy. So here we can see that we got the numbers, we got dollar, and I'll just make another notes list here. And we'll talk about what if uh create narratives, right? We got a bullish narrative and then a bearish narrative. So if we're bullish, if the dollar goes bullish, we'll trade USD, NZD, USD short if the dollar is bullish. Not much to go up against, really. That's not in the same boat, really, as the dollar. You might do pound, pound dollar short. And I think those may be some of the only ones to kind of stay outside of all the volatility popping around at the same time. But if the dollar is bearish, we got plenty to kind of go up against with that. So USD, CHF, we go short there. USD, Aussie, US, US dollar long, we can go Euro. This is probably the one that should be up first. Euro, USD, long. This is the star of the show. Same thing with some of the rest of them. We'll keep a similar similar outlook. Kiwi CAD, Kiwi CAD short if we're long there. Pound CAD short if we're long. Uh, if we're bearish, we'll go Euro CAD long. That's the star of the show. Aussie CAD long. And then we could also do CAD Swiss short, which is another good one. And if you get the gist of what I'm doing, what do you think that will do with the yen? The yen is bullish. What pairs would you put up against the yen if we think the yen is going to be bullish? I know I would for sure do Kiwi yen short, pound yen, could go short. I might doubt that, but it's not up to me. Trade the chart in front of me, not what I think. Then we got what else? If we think that the yen is gonna go bearish, USD JPY long. That's kind of like I don't know about that USD JPY, but Aussie yen long for sure. Euro yen long for sure. So these are my setups right now, my bullish and bearish narratives. And I'll go and we'll just go take a look at the charts again and try to see if these narratives for sure. Yeah, nah, for sure. Tab, you popped in here? When the heck did Tab get up in that jump? Okay, yeah. He said he'll watch it back when he get back. All right, cool. I didn't even see Tab popped up in that jump. And after an announcement, but for shorty. So that's where we are there. So we can come take a look at this. Now remember which pairs I talked about because it's gonna look like, oh snap, these do look like really good setups. I would have never came and looked at these like that. So now let's just, as I got these all basketed, we got the CAD is the first one on the list. So we talked about the CAD potentially. I'll come take a look at this from the daily perspective. No, we're good. From the daily, cool. So we talked about the bearish and bullish perspective, and I'll add the flags to whichever one we thought was that. And what I'll do here now is I will do that real quick and then paste the currency board right up on here so we can see what we got going on. Just real quick, so we can make sure we're paying attention to the relative strength while we got it. So we thought CAD and the yen. I don't want to put these two together. The reason being CAD yen is not on my list of pairs to trade is because both of them have monetary policy statements and both of them are weak. Like I don't want to put two weak pairs up against each other, so I'm not even going to put that one. Um, I'm not even going to do that. That's so we can start with Euro CAD because that's probably the best looking one, right? It should be the best looking one. And of course, it does look really good, especially here on the daily. We have this nice move to the upside, increase in velocity, decrease in downward momentum, increase in downward momentum, but velocity still says we have a little bit of a move to the upside, and that's all we really need is just a little bit of daylight to want to. We're pushing up into fresh new ground. We're right back here at this previous high. But as we got up to this high, we did find supply, but the supply was diminished at this level. So if anything, the range looks like this that we're working with. And that's not bad. A, B, over the next few days, we'll see them kind of walk down a little lower. They might even make it down to the 50 before they turn back around. They might make it back down to this low before they turn back around. I'm fine, but I do expect prices to continue up. The way I would attack this around crunch time would be maybe somewhere around the 2 hour or the 4 hour. I would come down here and come take a look. Here we've got this effort versus result spike. This is what I'm going to look at right here. I believe it's on this bar. Come take a look. No, which bar is this? This bar next to it here. So this is the bar that we can see. We had minimal effort, minimal result, but prices were really compressed right here. And then they used this price, this closing price. Let me use this one. Okay. They used this closing price of 1.60343, 1.60358. So the closes had increased from here to here. They tried to close below it and they were unable to close below that price. So this closed 366. They still couldn't get below 343. So you can see they were using 343 as their hold, and prices floated up above there too as well. So here we can see supplies diminishing up here at these highs. We see an increase in both demand and supply in this ultra high volume bar, but it's the same amount of volume as it was here, which this could be them absorbing the overhead supply because supply is introducing itself like we see here. We do see it in the up bar that created this ultra high volume. It shows a compressive force, something pushing back down on it, the effort to go up, but the resistance is there. So there's both supply and demand in that bar. A lot of supply, enough to push it down to about halfway. But then they, like I'm saying, they're using these bars to map out their highs and lows. They're mapping out what's a fair value and what's not, right? All on these bars, right? So if it's an up bar, I'm going to take the high and the close. If it's a down bar, I'm going to take the low and the close. Ultra high volume kind. So again, they've now pushed the price up to here. So we're going to be using this closing price of 730 as our new rebound for these lows. So it's really something looking like this as we come back down to get to here. So this is the area of interest and how we're going to map this out and how price is going to play around with this level. If it breaks out above, we'll be looking here. I came down to a lower time frame so I can get a good ATR. But back in the daily time frames, we know what's normal. The ATR is what I'm looking at up here. It's the average true range of the past 21 bars. So it's about 90 pips a day. So that's all we could really ask for in any one trading session, is about 90 pips on this pair. And down here on the 2 hour, it's about 25 to 26 pips. So we know that a normal stop out will be within 25 to 26 pips. So if you want to get stopped out, you would put your stop 26 pips. If you don't want to get stopped out, you would double it. So 50 pips is a good stop target here. So anything up above here. And what I would really do is once you get that kind of mapped out, you can understand that this is what everybody's doing. And what everybody's doing is more likely than not gonna not work out. So you put your entry where your exit would be. And now this is our actual position, how this looks like, how we'll attack this trade. We'll look for 3-to-1 RR target, which then puts us a little bit over what we would get in a day. But we're not expecting prices to really, because we're in this trend, we're in this consolidation, if you will. And to be honest, I feel like may have already been breaking out of this downward trend channel. Uh, Got something a little bit more like this. Phase A, phase B, really volatile here. And what we're gonna look for is three things. For our entry criteria, we're gonna look for capitulation. We're gonna look for compression and the prices next to that. And then we're gonna look for exhaustion. So in the areas where we see this, right, the capitulation, the next thing we're gonna see is a compression in the price bars next to it, right? You'll see those wicks on both sides, prices get compressed, and then we're going to see an exhaustion, this exhaustion of supply. And now note all of those ingredients are in the background. So we have the capitulation bar, the compression bar, and then the exhaustion. Because if we look at this down bar in relation to this down bar in relation to this down bar, these two are about the same amount of spread. But look at the volume. And we call this looking for the analogous volume. So this volume bar was this high, but next with the same amount of supply, as far as the range of the open and close is, look at the amount of volume now. How peculiar is this bar? So volume's gone down substantially, well below the amount of volume and the amount of supply that was previously in the market, driving prices down. So this is a marker here, this effort versus result. I actually made this indicator, by the way. Like I programmed the source code for this. And this shows me the effort versus result relationship on one of the bars that's the most, prominent as of recent. It's got a filter that just won't filter any bars. It's the ones that show a whole lot of effort, a whole little bit of result in comparison. So this bar is just it's like that doji, that classic doji, that indecision candle. But there is the decision that has to be made up here at this resistance to see the breaker bounce. So when you see these things at a resistance, what should happen? Prices should fall, but they didn't. Supply is actually being absorbed. There's actually a whole lot less supply in these markets. Right here, you can see that supply does introduce itself, or this could be buyers overcoming sellers and absorbing the overhead supply. So you got to be careful about what this is. I'm not going to make any moves until the monetary policy statements, but I will leave this up here to kind of base my decisions off of leading into this. Now, remember, like I told you, we could trade before, we could trade during, we could trade after. Each has its own risk associated. So, but here we can see everything that we want to see to give us a good bullish picture. And we have these bullish moves that are kind of hiding out before the monetary policy statement, and that's called pricing in. So the move may already be priced in. People may already be taking their bullish judgment and putting that towards this. We saw that there's plus 23,000 open interest positions here on the euro. I don't expect the euro to lose against any of these pairs that have monetary policy statements. However, you never know. And that's why we need to have a bearish narrative set up as well. So if the CAD does gain strength, I believe it will gain strength up against the Kiwi. So as you can see, there seems to be either no demand and no supply here. A big exhaustion candle showing up here. This could be an area where we have failure to break out above these highs, and that could put us into a movement that starts a more distributive price pattern. So you never know. And we could get this move that comes down and streaks through the range, right? And as we talked about, we'll look over here at the ATR. That would be, this is a 14 pip ATR. So this would be a 2x ATR move through there. And the amount that we came out of and closed above wasn't even one ATR. So I would consider this a fake out, if anything. Now, if we would have came out and done 2x ATR out of here, that 28, or maybe even, 42, that 3x ATR out of there, then that's a much more believable breakout. But 1x ATR is just enough to run stops and then go in the opposite direction. So just keep that in mind. So if the CAD was the one, and remember we said 14 pips was enough to get stopped out. So if you were up here saying, oh yeah, I'm gonna sell from here, you just got stopped out and now they're gonna run your direction. It's kind of crazy that that's the exact amount. So what do? We enter at that exit, add double, and then look to take that move 3 to the downside. So this is a contingent position, but if the CAD loses, then that's not gonna work out for us. But it has to come in, come up, check that, remain bullish, and then go back down. So that's something to come take a look at, just like that. CAD Swiss. Now, this is one that we expected prices to go short on here. I wanted you guys to see this. We have the capitulation to the downside, the spread, the exhaustion, the compression, the exhaustion, then the signal to buy. So if the CAD did gain strength like it is right now, like we said, we have that capitulation bar right here. We have that compressed spread. Like, why did you get so not bearish, right? The exhaustion bar right here, as we can tell, the smallest volume bar in relation to the two previous volume bars was this bar, and that is a sign of no supply. The confirmation bullish engulfing, that's a good sign to get in on the bullish side on this trade. You can run a bullish Fibonacci. You would have seen that that was a nice 61.8, a 50% retracement. Puts you right into profit. And we have our bullish targets. We do expect supply to show up here. And we do expect supply to show up here. So if you wanted to get in bullish, you can get in bullish and be aware that supply is imminently going to show up here at these levels at about 58 cents. And again at 58 100 or 58 150 and 58 250 would be the levels to look at. We would also want to see price come back down and supply diminish and exhaust again, potentially before taking that move to the upside. But when we get up to where we expect supply to introduce itself, if supply does introduce itself, then we can get right back in on the downside move of this. And that will give us a different style of fib, which we consider this fib, which is basically the opposing reaction. This is the same 61.8 level. So we do expect supply to show up here. Now, when we read that supply is how we plan on distinguishing between who's in control and who's not. We got these areas of interest. So we'll take note of that, which is why I love to do this with a few days ahead of time to consider and to see how price reacts. We're not in any rush, we're not in any hurry. We know when the market's going to be the most volatile. So yeah, just come take a look at those things. I'm gonna cut the recording now. Um, I think we got a good idea about what we're looking for. This is just looking at the CAD because the CAD was first. Looking at the Euro Swiss, CAD Swiss. Same thing was gonna happen over here with the dollar, Euro USD. Should look pretty bullish. Should have different, you know what I'm saying? This down move. It's like it's over. These down moves. This one finally increased and momentum to the downside, but we have this bounce. So I'd be looking for the second bounce of this oversold boundary, and that'll probably be the next best long entry. Yeah, we can tell here with this effort versus result spike on this bar, they're going to be using this level and potentially these levels as our range. Every time we get down below here, we end up right back within this range bound condition, which gives it reaccumulation vibes. But if we, yeah, another thing here, we just look at the ATR, 20 pip ATR, long positions need to be above. Everything needs to be above 20. So if you want to get stopped out, you put it up here like that for 20. I would say get me in here with a 40 pipper, which then puts me below. It looks like this, looks like another exhaustion, right? The capitulation bar into the support, which then makes it look like a breakdown below this bar, the compression. Then we have the ultra volume up bar, shows that buyers were also present as well as sellers, and then prices push back up. Here, another exhaustion bar, so capitulation, compression, exhaustion. This looks like a good area of interest. See they gapped up into it. Prices are still heading up. So yeah, it looks like a good opportunity. So if you trade a limit order, if prices wanted to shake down a little bit more, you could do that. But I don't expect them to come down any lower because they seem very exhausted at this point. So something like that. If not that, buy stops above the high. If not that, we have a contingent position to where if the dollar gains strength, I would expect it to gain strength against something like the Kiwi. So Kiwi USD with a short setup somewhere than this. We take a fib from the high to the low. Highest high, I mean highest close to lowest close. Yeah, we could see we could probably get a nice rejection here at the 6350 or the 6400 to catch that fib move to the downside. If not that, we can catch it on a sell stop. Again, 12 pips, 24 pips, 36. 24 times 3, 72. Yeah, before it like that, catch it like this, should be solid. That looks like a good move. Yeah, yeah, all of that. Aussie looks the exact same way. But here we've got this. I think I like Aussie dollar, the way that the effort versus result spike lines up with this, and then the subsequent bars are starting to go up. But this is a whole lot more. You can see here, supply starts to increase a lot on this move. So this could be a change of character for sure. Ozzy could continue to go down and break down, or could break out. Could do whichever. But we definitely know that this low is the lowest low that they wanted to go to because they didn't allow prices to fall below there. So that's my rebound point, and I'm not gonna. I'm long above here, short below here, and little things like that. So I'll come back and I'll come look at this. Like I said, I don't want to make this so long that it's too long to even try to watch or absorb. So yeah, if you got any questions, I'm gonna stop it here, and then we could do a second one that's just Q&A if you got any questions. But other than that, I am Audi 5000. It's your boy Jay. Yeah, y'all holler at me. Come see me in the subscriber group. We do this a little bit more often than not. Also, this fall I'm gonna be getting mentored by the Wyckoff analytics team and to help myself become an even better mentor and get you guys more volume spread analysis and tips and tricks and all the rest of this stuff. So yeah, that's all I got for you guys. Y'all be easy, stay blessed. As soon as I can find the Zoom thing, because it just kicked me out. Yeah, there we go. All right.